Okay, so this is getting into discussing the development of the capital asset pricing model, one of the most important theoretical pricing models in all of finance, probably only surpassed, in my opinion, by the Black-Scholes option pricing model because of its wide use and much stronger adherence to the prices seem to adhere to that model much more strongly. Simple reason for that is that the option pricing model is what we call a partial equilibrium model. We need to know the price of one thing, or at least assume that it's correct, and then we can price a bunch of other things, options, off of that one thing. A full equilibrium model says we don't need to know the price of anything. We're gonna create it out of whole cloth, if you will, and price that. That's what CAPM is. And it's much trickier to come up with a full equilibrium model than it is a partial equilibrium model. But that's also what kind of makes Black-Scholes so cool, is that, if I can assume that that price is right, boy, I can price those options all day long and be fairly assured that I'm getting the right price. CAPM, not so much. And that's why we also have a Fama-French 3-factor model, why we have a Q5-factor model, why we have a whole host of other factor models that make up the world of asset pricing in a full equilibrium. We even have different ideas about how to do it. There's this thing called arbitrage pricing theory, APT, that at least at undergraduate master's level, you'll never really get into unless you're doing a master's in financial engineering or financial economics or something like that. But that's an entirely different theory and a different way of constructing it. In fact, they're loadings on factors that we don't even know what the factors are. People are guessing at what these factors are. It's really quite esoteric. So CAPM is probably the most useful, though, of these full equilibrium models. So start off with a very basic premise that was laid out back in the 50s and 60s as this model was developed. So we start talking about diversification and the benefits of diversification. Clearly, it's, it can be summed up by, where did I put that? I thought I had the slide of the basket of eggs. I guess I've got that in chapter 12. Sorry. But it's very simple. It's don't put all your eggs in one basket. That's what diversification is. Don't assume that everything is going to be all right. If I have that one egg and I'm walking along with it and I trip and I fall and the egg breaks, we're done. It's really that simple. So Harry Markowitz is known as the first to really examine this, or at least the first to publish this. As I've said in the past, many people were thinking this at the time, but Harry happened to be the one to publish it. So at very little cost, we can hold a bunch of different companies and get away from some of the risk associated with any individual company. Let's also talk about calculating some measures. We're going to talk about a measure of return. We're going to talk about a measure of risk. The measure of return that we talk about is the expected return, so it's a weighted average. And again, here's that friendly sigma summation symbol in math, right? So we're summing from s equals 1 to n, and here this p sub s is the probability of a particular state occurring in the future. So this is actually a one-period model. We start the world out in a very simple world begins here, world ends there. Or actually, from your perspective, world begins here, world ends there. One period. Now, this has been generalized to a multi-period model without loss of value out of the model, but that's how they started out. Start really simple. If you ever built the model as a kid, when you're young, you built the model where you kind of snap two pieces together, and it sort of kind of looked like the thing that you were building the model of. Then you get a little older and you get, a dozen pieces you put together. You get a little older and you get, and then some decals, right? And then you get older and you get 100 pieces and you've got to paint the pieces and all that jazz. That's kind of what we do with research too. We start off simple, and then we get more elaborate as possible so that it better reflects the real world. So that's the probability of a particular state occurring at the end of this period. And you can think of states as states of the economy. So the economy is in a boom state, it's in a relatively stable state, or it's in a decline, or maybe it's in a trough, that sort of thing. But we could have up to n of these states. Then we multiply that probability by the return that we expect to get in that state. We add all those suckers up because of that sigma, and we get this thing that we call an expected return. Whatever state occurs, that's the return we get. But on average, because we're starting at time 0, we don't know what state's going to occur at time 1. So we buy this thing with the idea that it could be any of these, but on average, it's the expected return. And by the way, this does look a lot like an average, doesn't it? If the probabilities of each state is the same, it's exactly like a simple average, adding a bunch of returns together and divided by the number of periods or the number of states. So suppose we've got 2 stocks, and this example I think is useful to spend a little bit of time on because it lays it out quite nicely. We've got StarSense and JPODs. Looking at a period of 1 year, investors agree that the expected return on StarSense is 25% and on JPOD is 20%. So the question then becomes, why would anybody hold JPOD, right? Because, heck, I can get 5% more by holding StarSense. The realized return, of course, can be significantly higher or lower. Remember, only one state actually occurs. And if StarSense is a higher expected return, what do we already know? Well, higher expected return means probably higher risk, so wider variation between the realized returns that we might get in any given period. And so here, if we assume we've got either a recession or a boom, and there's an equal probability of each, and of course the probability is sum to 1 because one or the other is going to occur for sure. And then we see StarSense in the recession state gets a negative 20% return, and in the boom state gets a positive 70% return. JPOD, on the other hand, actually is somewhat counter-cyclical. So in the recession, it has a 30% return. In the boom state, it has a 10% return. But the key thing is to notice that there's only a 20 percentage point difference between these two, whereas here we have a 90% difference between these two. So lower risk for JPOD, higher risk for StarSense. Now, and they just go through this exercise down here, 0.5 times negative 20% gives us negative 10%. Add that to 0.5 times 70% gives us positive 35. Add those two together, that's how they get to 25. Likewise with JPOD. So far, easy peasy. Suppose that there's a risk-free asset that has a return of 8%. And so now we can actually calculate that excess return, or AKA the risk premium for StarSense and JPOD, just by simply subtracting the 8% from the return. So 8 from 20 is 12%. 8 from 25 is 17%. Now we want to try to get that measure of risk, right? We've got the measure of centrality. What is our expected return? Now we're trying to get that second moment of the distribution, the measure of risk, and we go to variance. And in fact, we actually, to make more sense to us, we actually take the square root of variance and we get a standard deviation. So variance, again, we've got a probability of state S occurring. We're still summing over all of the possible states, not times, possible states, because this is just a one-period model. And we're taking the difference in the actual return in that state S subtracting from it the expected return that we just calculated. So for StarSense, that's 25%. For JPod, that's 20%. So, and you'll see the numbers here in just a second. Then one last thing we're doing that's important here is we're multiplying those two things together or taking it to the second power. So in other words, if we get a negative here, a negative times a negative or a negative squared is a positive. Likewise, a positive times a positive is also a positive. So that gets away from the problem of the negatives canceling the positives and us getting a measure of variance that is very close to the measure of expected return. Meaningless. Another way to do it would be to take the absolute value of this. That's a possibility too, but the way statistics were developed originally, and again, a lot of the things that we use today have some sort of historical evolution built into them. So the reason we do this squaring it instead of absolute value, which would make more sense because a fairly significant deviation is going to blow up by the time we square it. So if you just take the absolute value, we don't have that problem. But the issue is that back when the statistics were developed, back when we were learning about this, it was more difficult to do an absolute value than to square things. So we ended up with variance as the squared instead of as an absolute value. The other thing when we're talking about returns, what's a squared return mean? Don't know. Squared speed is acceleration, but squared return, don't have a definition for it. So let's just take the square root of it and call it good at standard deviation. So that's why we typically talk about a standard deviation rather than a variance. So here are the numbers, and I won't belabor it, but here we've got our probability. Return if recession state occurs. Remember, this is StarSense here. And so the probability, and we're calculating our expected return here again. Then we're going to use that down here. And here we have, again, the probability of each state occurring. We have the return if that state occurs. And now we put in our expected return, and we subtract that from the state return, and we get a negative 0.45. We square that, and then we multiply it by the probability, and we get that. We add both of these up, and there's our variance. Take the square root of that, and we get our standard deviation. Okay. We can do a similar thing for JPod, and so we get a standard deviation of 10% for JPod and 45% for StarSense. Questions so far? Okay. Now, the risk premium, if we assume slightly different probabilities here, all of a sudden things shift around quite a bit. So if we assume an 80% probability of recession and only a 20% probability of boom, instead of an expected return on StarSense of 25%, we get a -2, and on JPod, a positive 26. So getting these probabilities of a particular state occurring, this demonstrates just how important it is. All right. Now, suppose we want to put these things into portfolios because it's not clear which is more valuable still. Now, we figured out that JPod is less risky, and that's why it's got a lower expected return. But does one dominate the other? Is one more preferable than the other? And maybe we want to hold both of them together in a portfolio of some sort. So let's figure out how are we going to get those weights, and how are we going to figure out what the expected return and the variance of that portfolio is. Well, it turns out that the expected return of the portfolio is really simple. It's simply the sum of the weighted expected returns of the individual securities, so StarSense and JPod. Whatever weight we have, In other words, how many dollars? If we have $100 and we put $50 into StarSense and 50 into JPod, the weight of each would be 0.5. So it's simply a market value weighted weighting scheme. So it's simply the sum of the weighted expected returns of the individual assets. So here, if we do that, they calculate. We've got all of our money is 1, and let's see. I think let's see. Yeah, here we're putting half our money into each, and so we end up with an expected return that's halfway between the two, right? 22.5%. So 0.5 times 20% plus 0.5 times 25% gives us 22.5%. The expected or the variance of the portfolio gets a little dicier. So here, again, we're dealing with that probability of each state occurring. We've got the expected return on that portfolio in a particular state. So that's the double subscript. The P is the portfolio and the S is the state. Then we subtract from it the expected return of the portfolio, the 22.5 that we just calculated right back there. And then we square that. And of course, sum it up. That's what this means. We got two states, n is equal to 2. So we end up with a standard, and then we can, of course, take the square root of that, and we get a standard deviation of 17.5%. Let's go back, look at the standard deviation of each of these individual guys. So it falls somewhere in between, right? JPod by itself was 10. StarSense by itself was 45. And let's see, let me do this. We're just about a good time to wrap up here. If I can find the spreadsheet, I think it's back here. Come on. Ah, here we go. There we are. What? Okay, there we are. I was going to say, what the heck? Didn't clean this up when I last left it. Okay, that's pretty clean. All right, so what we have here is a spreadsheet where we, up in this upper corner here, we could have, this could be StarSense and JPod. I've got it listed actually as stocks and bonds. We've got 12% expected return on the stocks. We've got a 6% expected return on the bond, and we have a risk-free rate of 8%. We have a standard deviation on the stocks of 15%, a standard deviation on the bonds of 10%. I'm going to make this correlation. I'm going to change that. Oh, sorry. Now I'm going to change this. We've got a correlation of negative 0.015 at the moment. I want to bring, okay. And we have a correlation between the stocks and the bonds of 1. All right. So when I do that, when I plot that out over here, what I get, doggone it, sorry for the mess here. I didn't realize this was still cluttered with all kinds of markings. Try to get rid of most of them. All right. So here I have my stock right here. And down here is where my bond plots. Now, if I have 100% of my money in the bond, I get a return of 6% and a risk of 10%. If I have 100% of my money in the stock, I get my 12% return, and I have a risk of 15%. However, I could split my money between the... All right, now it's freezing up on me. Come on, behave. Doggone it. Oh, there we go. Okay. Oh, no. Start that over. So I could, if I had if I had only 90% of my money in the stock, I could be over here. I could be right here. If I had only 80% of my money in the stock, I could be right here. That would be 20% in the bond. So I could move anywhere along this line. Notice that the correlation between these two things is 1, and notice that this isn't exactly a straight line between these two. Now, here's the magic of diversification and uncorrelated assets. Let's change the correlation from 1. Let's change it to, what do you want to do? 0.5? Come on, keyboard. Let's change that to 0.5. Oh, all right. So what happens here at 0.5, instead of being a line between these two, I now have a curve. In fact, that curve, it looks like at its furthest point to the left, is actually a little left of our bond. Right? By, well, let's say the bond is at, what, 10%, did we say? Well, this other portfolio right here that's composed mainly of the bond, but some of the stock, is actually at 9.75% risk. So now I've taken two things that both have risk in them, and I've combined them, but because their returns are uncorrelated with one another, they're not perfectly positively correlated, I've been able to create a portfolio that has less risk than either one of those by itself. And this is probably one of the most important findings in all of finance in terms of diversification and holding portfolios, and why diversification is important in a portfolio. Let's change that to even a little bit less than 0.5. Let's change that to 0.2. Now I can get to a point here, this point right there. Come on back. Oh, no. Don't do that to me. Now I get to this point where I only have 9% risk, and I have a higher return than the bonds. Lower risk than the bonds, higher return than the bonds. I said that wasn't possible. Well, it is possible if I combine these securities that aren't perfectly positively correlated with one another. Perfect positive correlation means we're on this straight line back here. But if we're not doggone it. If we're not perfectly positively correlated, we can get this curved line out here. So we can attain risk and return trade-offs that we couldn't otherwise get with the individual assets themselves. When it comes to building a portfolio of our assets, we need to figure out what the weights on each security are within that asset. And we do that typically on a value-weighted basis. So we take the entire dollar value of our portfolio. Let's say it's $100. If we put $45 into one security, we've got a 45% weight on that security. We put the other $55 into the second security, we have 55% weight on that security. So it's a percent of the market value of each security relative to the sum of the market values of all the securities within our portfolio. When we calculate an expected return on our portfolio, I want to circle that subscript there. Subscript capital P is the expected return on the portfolio, not the security. Notice that the expected return on the security is subscripted with a small I. So security I equals 1 through n. So we have n securities, and we're just summing up the expected returns, and we're using that percentage weight. So in the example that I gave, security 1, we put $45 into. Security 2, we put $55 into. We have a total of $100 in our portfolio. So when I do this weighting, or when I calculate the expected return of the entire portfolio, it's simply 0.45 times whatever the expected return is on security 1 plus 0.55 times the expected return on security 2. And that becomes our expected return on the portfolio. So when we get our portfolio returns, it's simply the weighted sum of the individual assets. Fairly simple there. Gets a little more complicated when we start talking about the risk part of it, when we start talking about variance. Here's an example of calculating portfolio returns. I'm not going to go through that. You can walk through that, but that basically just shows you that same exercise over. Now, portfolio variances, when we have, and by the way, I should point out, this assumes that we have the expected returns of each security, probability of state 1, 2, or 3 occurring. And so that's this particular variable. We see the expected return on the portfolio for a particular state. All right. And then here is the expected return for the portfolio across all states. So basically we're just getting this part right here is deviation of a particular state return from the average. Okay. And then we're squaring that, as we do when we calculate a variance, so that we get rid of the negatives and they don't just cancel each other out. And then, of course, we're summing across the various states here. And that's going to provide us with a variance for the portfolio. Okay, so now we've got an expected return for the portfolio, and we've got a variance for that portfolio. And again, here's an example. I'm not going to spend time going through that example. They do also talk about constructing a portfolio of risky assets where we could actually, if we could get this weighting and if we had these particular assets, we could create a portfolio that has zero risk. And I believe we started looking at this at the end of the last class last week. But let's walk back through this again, because I think this is an important result. You can't quite get all the way there. You can't actually cancel out all of the risk simply because those assets don't exist in the real world. So what we're going to be looking at here is only theoretically possible. Now, in the real world, we can get closer to this, but we just can't quite completely erase the risk, obviously. Those securities would be very near and dear to everybody's heart if we could get those. So this particular example, I've got stay over there, don't move. I've got some data for two different securities. So I've got a security here that I call stocks, and that, and that security has an expected return of 12% across all states, a standard deviation of 15%, and then I've got another security that I call bonds, and it's got a expected return of 6% and a standard deviation of 10%. And I actually even have a risk-free security here that I'm not plotting, but I'll show you how I'm going to use that in just a minute. And then I've also got a correlation for those two securities. How does one security move relative to the other? Now, the way I've structured this is that I'm changing the correlation between these two things. In the real world, we don't get to pick that. The correlations are what the correlations are. But I want to show you what happens when we happen to find an asset that has a very low correlation or possibly even is negatively correlated with another asset. And this is where we get to that point where we can substantially lower the risk of the portfolio below a point where even neither of the two assets standing alone reach that level of risk. We can actually reduce the risk beyond that of either of the assets. So right now I've got it set for 0.2. And if we go over here and look at the plot, we see here's our stocks are up here. And let's see, let me go back and draw. So our stock portfolio is there, and our bond portfolio is down here. Now, when there's a 0.2 correlation, remember, correlation goes between 1 and -1. All right? It never goes outside of those range. And also remember that correlation is simply covariance divided by the standard deviation of one series times the standard deviation of the other. So you can think of it as a scaled covariance. Covariance varies from positive infinity to negative infinity. That creates some problems for us because it's difficult to compare one covariance to another covariance. So correlation is handy because it's scaled by the standard deviation of each of the two series within the pair. And that allows us to compare, say, a pair of stocks A and B to a pair of stocks C and D, and say that one pair is more highly correlated positively with the other than the other pair, or vice versa. So correlation is a handy thing to have here. Right now, I would say these are positively correlated, but not strongly positively correlated. 0.2 is relatively low. Many assets that you're going to find in the real world have a correlation of 0.5 or higher with their other assets, and for that we don't get quite as much bang for our buck in terms of lowering the risk of a portfolio. Now, so when we look at this, we've got this frontier, and this line, this white line right here, that goes between these two is the realm of possible portfolios that I could create by combining my stock portfolio with my bond portfolio. If I was 100% stocks, I'd be right here. If I was 90% stocks and 10% bonds, I'd be right here. If I was 80%, what is happening here? 80% stocks, 20% bonds, I'd be here. You get the idea all the way down here, 0% stocks, 100% bonds. So these are all possible. This white line represents possible portfolios that are combinations of both my stock and my bond portfolio. you'll notice also that the riskiness of this, the bond portfolio, is at 10%, right? But there's this portfolio right here that has a higher return than my bond portfolio, but it has a lower risk than my bond portfolio. In fact, it has the lowest risk of any possible portfolios that I could create out of these two assets. And we call that the minimum variance portfolio, MVP. And we can actually calculate the percentages of that minimum variance portfolio. There's a formula in your text that allows you to do that. Why is this portfolio important? Well, because that's the dividing line between efficient portfolios and inefficient portfolios. All right, so right here, this part of the line right down here is the inefficient part of the line. Why is it inefficient? Because if I wanted to say, if I wanted a 6% return with a 10% risk, I could buy the bond portfolio, put all of my money in the bond portfolio. But why would I do that if, keeping my risk constant, I could actually go up here and buy this portfolio, which is, it's probably about 60% bonds, 40% stocks. And instead of getting a 6% return, I would get more like a 9% return. Remember, I'm keeping my risk constant. I'm not changing risk. So that's why anything below this line, and I draw that line right at the minimum variance portfolio. Another way to think of the minimum variance portfolio, if you take a vertical line, right, like this one right here, and you start it over on the left, over here, and start moving it to the right. When it touches that curve, the first point it touches, that's the minimum variance portfolio. That line right there, anything above that is an efficient portfolio. I could also say that those portfolios dominate any other portfolios that I could construct. And by that I mean dominates these down here, the inefficient portfolios. So none of these are portfolios that I would ever hold, because I can always do better. I can always reduce my risk reduce my risk and get a higher return by going up here, right? Oops, turned on my eraser. So I can always, so maybe I wanted less risk. Well, I could go here, but why would I go here when I could still go here and get more return? Likewise, even here, I could reduce my risk and still get more return by going up here. Now, at this point, nothing else is going to reduce my risk any more than that, because that's the minimum variance portfolio. Now, as I move up this direction, now I'm trading off risk and return. That's a different decision that I'm going to be making. And the way I make that decision, I'm going to add one more element to this graph, and hopefully not make it too busy. Let me erase some of this. I'm going to add utility curves to this graph. The text doesn't really go into this, but this is an important piece to the puzzle that maybe you're puzzling about too, is, well, why would I pick a particular portfolio over another? Well, the reason is that you have a certain utility function. and I have a utility function. Our utility functions may look different. And that utility function is how we perceive the risk-return trade-off. So I might have a utility function that looks like this. And each of these curves, you all have looked at weather maps, right? You know what barometric pressure looks like on a weather map? You have these isobars, right? Those are lines of equal barometric pressure. You know, so you get these little circles and then bigger circles around them. When you've got a low pressure, that inner circle has the lowest pressure, and then the next one, the concentric circle outside of that, has a bit higher pressure, and the one outside of that has higher yet pressure again. But along each of those lines, the pressure is the same. It's an isobar. It's the same thing. Well, you can think of these as like that. So in terms of utility, my utility along this curve, now I'm erasing my curves. My utility along this curve, and I'll call it utile curve 1, my utility is equal. It's an iso-utility curve. So if I have a combination of, let's say, 2% risk and a little more than 8% return, I have the same utility as if I were to have a portfolio of 4% risk with a little more than 9% return. I get the same utility out of that. And in economic terms, when I talk about utility, think of it as I'm equally happy. I'm indifferent between those two portfolios. I would take either or. Doesn't matter. And likewise, this portfolio, and this I'm indifferent between all of these portfolios. Now, this next utility line, though, this is utility line 2. That line, I'm much happier at that line. Along this line, I'm equally happy with any of these combinations. Here's utility line 3, utility line 4, and likewise, these I'm equally happy with. This one actually is one that intersects with my efficient frontier. This is the only curve that I can actually achieve a portfolio that will satisfy one of the points on my ISO utility line here, and that is utility line 4. So that is the portfolio that I will hold. And I'll be happy with that portfolio. I'd be less happy with this portfolio or with this portfolio because they would fall on yet another curve that's further to the right. And I could even draw that curve. So let's put it up, put it in here. That curve gives me less utility. So I'd rather be up here on curve 4. And there's that portfolio. That's going to be the portfolio I hold. All right, now your utility function might look very different than that. Let's say your utility function is more like this. And you intersect with the portfolios over here. So you're going to have a portfolio that has a higher level of risk with a higher level of return than the portfolio that I chose, which was down here. All right. But we're still all choosing portfolios that are along this efficient frontier. All right. And above this line. There's no reason to go down here. So nobody holds those portfolios. Nobody holds that combination. Now, the last piece to this is really and I'm going to kind of jump the gun here because this is kind of the end result out of chapter 12. But I want, since we're talking about utilities and we're on this curve already, let me just show you what happens at the end of chapter 12 that gets us to the CAPM and is why beta is the only measure of risk and why holding the market portfolio is the only portfolio that we all hold. The difference is that some of us hold more percentage of our portfolio, our assets in that risky market portfolio, and others hold less. So I'm going to get rid of these lines here. Let me add one more thing to this chart, and that is going to be my risk-free. And over here, let's see, get out of that. And I don't like that risk-free that I wrote in here, so we're going to pick a different risk-free. We're going to pick a risk-free of, let's make it 4%. Oops. There we go. All right. Didn't really have to do that, but. Okay, so now I'm going to add to this chart the risk-free asset, and it is right there. All right, there's my risk-free. 4% return, 0 risk. That's why it plots there. Now, the other thing I can do here is I could make combinations of my risk-free and the risky portfolio. So I could put part of my money into the risk-free and part of my money into the risky portfolio. And what I would do is I could start, let's say I took this as the risky portfolio, and I'm going to draw a line between these two. And what I could do is I could achieve any point along this straight line. By the way, the reason this line is straight is because my risk-free portfolio or my riskless asset has no variance. So when I calculate the variance of my portfolio, there's just one element. Comes from here. So I don't get any curve. There's 0 correlation between these guys. So I'm on a straight line, and I could get this. Right about here, I've got 50% in the risk-free and 50% in the risky portfolio. And right about here, it's about 75% in the risky portfolio and 25% in the risk-free. I could even get over here by borrowing money at the risk-free rate and putting extra money into the risky portfolio. So I can get riskier than that particular portfolio. But the trouble is, anybody see what the problem with that particular portfolio is? That risky portfolio? Would you prefer any other combinations? Let me put it to you that way. No? What about something up here? Or maybe up here? Because if we were to take one of these up here, we could draw a line, and hopefully I'll do this sort of right. I'm going to cheat, I guess, if I don't. Let's say that line right there, that portfolio, is the combination between that and my risk-free. That's the line that just touches, I guess I should do it this way. It just touches that efficient frontier. It's the first point of contact with the efficient frontier, and that's right there. Everything else, any other combination is either out here, which I can't achieve, or it's down here, which I probably don't really want to be here, right? Because if I'm on this line, but I could be up here, wouldn't I rather be up there? I get more return keeping risk constant. Or I could go from here and I could go all the way back over here. I could reduce risk and keep return constant. Could do either one of those. So this particular line right here is a really unique line. And it's still a combination of a risky portfolio made up of my bonds and my stocks. But combining a third asset, that risk-free asset down here, and that gives me this new line. I'm no longer constrained by this curved efficient frontier. My new frontier is this straight line, and it touches right there. So now combinations of, say, 50% in the risk-free and 50% in the risky portfolio get me here. So I'm always better off. I'm getting higher return keeping risk constant, or keeping return constant, I'm getting a lower risk by going there, right? I could put all of my money into the risky asset, and I would be right here. I could borrow some money at the risk-free rate, and I could invest that plus my own money into the risky asset, and I would get out here. All right, now one last step. I'm going to bring back our ISO utility bars. Okay, mine are these. Oop. And yours are up here. You all are younger. You're taking more risks, possibly. So you're going to have a portfolio up here. I'm going to have a portfolio down here. And I know this is getting a little messy. Should have changed colors there. But the unique thing is that we're both going to hold the same risky portfolio. We call this the market portfolio. It's a combination of all priced assets in the marketplace. You're going to hold a market portfolio, and you're going to borrow money to get out to this point. So this would be those of you that are the big risk takers out there. Maybe there's yet somebody else in the class who is still going to have some of their money. Let's see if I can change colors here. See about that. So there might be a third person with utility function that looks like this. And so you're going to be right there. So we've got one person up here, got one person here, and here I am, closer to retirement and being much less risk, or being more risk averse. But we all hold the market portfolio. We don't hold this portfolio. We don't hold that portfolio. We don't hold that portfolio or this one. We hold the market portfolio. It's a combination of all securities. And we hold that in some combination with the risk-free. In my case, I hold about 60% in the risk-free and 40% in the market portfolio. In this person's case, it looks more like about 60 in the market and 40 in the risk-free. And this person is actually negative 20% in the risk-free and 120% in the market portfolio. So they're leveraged. Remember chapter 2, we talked about margin leveraged positions, right? That's really where chapter 12 gets us to. So this was kind of a little bit of jumping that gun. We're going to go through some of those details, but putting it in the context of utility functions and everybody holding that same market portfolio is a really important insight that I want you all to have. Questions at all about this? Does this make some sense? Does it help bring together those two chapters possibly a bit more? Bring together this theory of the capital asset pricing model too? Because like I say, they simplify this stuff, and sometimes simplifying it too much takes away some of the raison d'etre that, or some of the intuition that you might otherwise have. I think adding back these utility functions and talking about that helps to explain it. All right. Questions? Of Chapter 11 looks at diversification and risk. And this is the classic, don't put all your eggs in one basket. And here's the reason. This picture is a classic picture that is in the research way back in the 60s. And what they did here was they said, well, let's compare the riskiness of a variety of portfolios with different number of securities in those portfolios. So let's start off with one security. We're going to take a whole bunch of single securities by themselves and get an average of the standard deviation of those portfolios. Well, it's hard to call it a portfolio when it only has one security in it, right? But let's, for argument's sake. And what we see is that on average, those single asset portfolios have a fairly high risk. Now, we add one more security to that, so now we have a portfolio of two securities, and the level of risk drops, and it drops fairly steeply. And we add a third security, and again, it continues to drop at a fairly steady pace. You'll notice, though, that it's not going down quite as quickly. So the second derivative, is non-zero. And you'll notice that by the time we get out here to 10 securities in our portfolio, risk has dropped substantially. It's halved. But now, by adding another security, that 11th security, we still get a little decline in risk, but it's nowhere near what we had up here. It's just a relatively modest drop. And so now we keep adding securities to our portfolios and calculating an average standard deviation. And what we find is that this line asymptotically approaches horizontal. And we could add, 10,000 out here, and we would still be just a hair above that line. And so they've called this light brown area here, non-diversifiable risk. In other words, no matter how many securities we have in our portfolio, even if it's the entire market, we still have that level of risk. That is not only non-diversifiable risk, it's also market risk. That's why we invest, to get that. It's this mauve color here. That risk is risk that we can easily get rid of simply by adding an additional security to our portfolio. That risk is idiosyncratic to each of the securities. So, in fact, I can achieve most of the reduction in risk by having a portfolio of 30, 40, better yet, 100 securities. Then I'm out here somewhere. And that gives me the bulk of the reduction of that diversifiable risk. I've gotten rid of most of that just by having 100 securities in my portfolio instead of 1 or 2 or 3 or even a dozen. I still have some of that risk up here if I just have a dozen securities in the portfolio. Very important result. And again, you see this replicated over and over and over again. This still holds to this day. One other thing that they discuss as you get to the end of this particular chapter is this idea, the fallacy of time diversification. And time diversification is the concept that If we're holding a risky portfolio for a long period of time, say on the order of 20 or 30 years, that a particular decline in return is not going to hurt us as much as if we were to, say, only hold that portfolio for 5 years. And there's a bit of a fallacy in that. We still want to hold it for that 10 or 20 or 30 years, but it's not because of what you might think. If you're looking at geometric returns, that standard deviation drops to nearly zero as the holding period goes up. You would actually, you might think to yourself, why would I get any return for that if I can guarantee that my variance, my riskiness goes to zero? Why should I get anything for that? The answer is the reason you get something for that is that what matters to us more is not the variance of the returns themselves. It's the variance of our ending wealth. So if we look at this on a wealth perspective, what we find is that the standard deviation of our wealth goes up in line with our wealth. So if we put in $1,000 at the beginning and we hold it for a year, we get 11.8% return. So we end up with 1118. But if we hold that for 40 years, we end up with $50,000, a shade over. The problem is that the variance of that wealth does not go to zero. It actually stays fairly sizable at 20,000, either side of 50,000. That means that, boy, we might end up just one standard deviation. Either side of that means that we could either end up at 30 or 70. It's a pretty big range. If we talk about two standard deviations, it's even bigger. Obviously, that would be either 10,000 or 90,000. So the reality of this, the reason that we want to hold for longer periods is obviously we get we get that extra return, the return on the return from the prior years, and so that's helpful. But even though the variance of the returns themselves declines towards zero, the variance of our wealth still remains relatively high. So that's why we should still get a risk premium for taking on this sort of risk. I wanted to also show you a spreadsheet that relates directly to this. All right, so this little spreadsheet right here says, well, let's put $100 a month for the first year into an account, and let's invest that account entirely in equities in the stock market. And every year thereafter, we're going to increase our monthly investment by 10%. So year 2, we're going to put $110 every month into our investment account, and it's still going to be entirely in equities. And we've got an expected return on those equities of 11%. And so down here are some of the assumptions. Oops. Yeah, of course, I can't move this. If you look down below, starting at row 18 here, you'll see various returns down here. And these are, what we're getting here is they're drawing returns out of a distribution of actual returns that we've seen over the past half a century, 3/4 of a century. So these are actual returns and actual distribution. And each year, the algorithm in this spreadsheet is just saying, well, let's draw this return out for year 1, draw that return out for year 2. And we're drawing with replacement. And so we draw out, I think we're keeping this open for, I believe, for 35 years. And then we add up all the money that we get at the end of it, including our profits from investing in the equities. And you'll note that up here in column F6, Principal in year 35 is $1.89 million. So out of this set of draws, we've got 35 draws out of that distribution of actual stock returns. Out of this set of draws, and investing $100 a month every month for the first year and increasing that at 10% for each year thereafter, we end up with almost $2 million. Now, let me just take a different set of draws out of that. So remember that 1.9 million that we have right now. I'm going to recalculate this, and we're going to pull a whole new set of 35 returns and recalculate the value at the end of that 35 years. We got even a better draw this time, almost $2.2 million. Same invested capital, right? We didn't change how much we put in. All we did was look at a different draw out of the real world of returns on a broadly based equities portfolio. Let's do that again. Oh, that wasn't such a good draw. $1.2 million. So we're like $1 million down from the last portfolio. Same distribution, remember. Now we're at 1.5. Ooh, even worse, 985,000, a little under $1 million now. Remember, we're putting the same amount of money in. The only thing that changes is the combination of draws out of the distribution of returns. Now $8.99. Back up to 1.35, 1.1, up over 2. All right, which one of these do you all want? I know I want the one that said 2.2 million, but guess what? I don't get a choice in that. Neither do you. We get one pass through that 35-year span. Is it the 2.2 or is it the 0.8 pathway? The reason that when you have a longer horizon that you can take that greater risk is that if it looks like you're falling into that 0.8 version or even worse, you've still got time to make it up. You can start contributing more to your monthly investment in your equities portfolio, in your retirement portfolio. So that helps. Hopefully, that helps you to see why this time fallacy exists. Yes, the return variance does go to zero, but the variance of our wealth does not, and it varies substantially depending upon which pathway we get. And remember, we only get one pathway through this whole mess. And you'll see that it's, let's see, oh, we got 2.6 there. 9.63. It's looking for more like one of those. I've seen them fall down. There's a 7. 768,000 versus 2.6 million. Remember, same invested capital. It's amazing. All right. Back to our PowerPoint. I won't go through this detail. I think that spreadsheet really says it all, quite frankly. And this chart actually gives you the same sort of picture. We could either be in, as they call it, Rowboat City, or we could be on the French Riviera. And it really is just a random draw. Which of the pathways through this do we get? My 35 years are going to be different than your 35 years, but it is what it is. And luckily, when you're back here and you see that you're down here instead of up here, well, you've still got quite a few years to start contributing more into your retirement portfolio so that maybe you're not on the Riviera, but at least rah-rah yacht. I don't know. I didn't make this up. This is somebody else's idea of difference in wealth. Anyway, you get the idea. All right. Why does diversification work? It's all has to do with correlations. If we had assets that were perfectly positively correlated with one another, in other words, a correlation of 1, there would be no point to diversify. Very little could be gained out of that because we don't get any of that benefit. Remember, when we change our correlation between a pair of assets to 1, we get a straight line between those two. There really is no advantage. It's only when it's slightly less than 1. And here again, a picture is worth 1,000 words. Perfect positive correlation, everything moves together. Negative correlation, opposite directions. And zero correlation, there is no predictable pattern. Another way to think about this is if something is positively correlated with something else, if you tell me how that one thing moves, and I know they're positively correlated, I can tell you, or at least make a pretty good guess as to what that other thing does. So if you tell me that that first thing went up, more than likely the other thing went up too. Likewise, if they're negatively, if you tell me that that first thing went up, then I'm going to tell you the second thing went down. If it's zero correlation, you tell me what the one thing did, I have no clue what the second item did. That's zero correlation. Another example of zero correlation is an asset that has no variation. So if I tell you that, this asset got 6% return, you still don't know what the other asset did, because I'm going to tell you no matter what time it is that that thing got a 6% return. So you have no way of predicting what the other asset does. The other thing to note here about diversification, and again, the text I don't believe gets into this in any sort of detail, if at all, but we gain in diversification when we diversify internationally too. So you might think, well, I just buy the S&P 500. Well, yeah, the S&P 500 is focused on U.S. companies. Now, many of those companies are multinationals, so they do have foreign exposure built into them, but they are focused predominantly on the U.S., and they don't have all the exposure that we might gain if we went to all of the various countries around the world and invested in each of those countries in some fashion or another. And the thing here is that you can think about it when the U.S. economy is doing well and another country isn't doing so well. Okay, so that's kind of that negative correlation. U.S. is up, the other country is down. They're negatively correlated, though, and that helps us to reduce our risk of the portfolio when we hold both assets from both countries. When the U.S. is down, the other country is up, then we get the benefits of that. You get the idea. Here's the dirty little secret, though. What happens when things go bad in one country? Well, we're so connected with all the other countries that many times, and it doesn't happen, it's not just the U.S. It could be in the U.K., in Europe, in Australia, in Asia. But when one country has a major problem, it often gets translated into the other countries. So when China has a problem, the U.S. economy might have a problem as well, and vice versa. So what happens when we calculate these correlations between countries, we might find that one country and the other has a correlation of 0.2. And we think, oh, great. So I'll split some of my assets up. I'll put some in the other country and some in my home country, and I'll get a benefit out of that. I'll be protected in some fashion. The problem is that when we have some sort of catastrophic event in one country, it often creates a contagion in the other country. And what happens to the correlations? They go up. So that safety that we thought we had built into our portfolio evaporates right in front of our eyes. So during normal times, oh yeah, the correlation is 0.2. During bad times or some sort of catastrophic event in one country or another, correlations go up to 0.8. So these correlations are not stable over time. They vary temporally. So we have to be very careful about that. So this particular example that they show you here, let me jump way ahead right here, where we're adding a foreign stock, that doesn't always give us protection, because when the chips are down, if you will, when things go bad, correlations go up. And all of a sudden, instead of being out here on this frontier, it contracts. Everything contracts back in. And so we don't get that same level of protection that we thought we were going to get. All right. Questions so far? All right. So here's an example. We've got stock A, we've got stock B held individually. Put them and notice that we have some periods of time when each of those have losses. But if we put them together in a portfolio, we don't have those losses. We have a lower variance, lower risk overall. How do we calculate the variance of a portfolio when we don't know the actual returns in each state? So what we do is we actually take the variance of each individual security or portfolio. So if it's a stock portfolio and a bond portfolio that we're putting together, or maybe it's two individual stocks that we're putting together, either way, we take the variance of each of those two items, A and B. So here's the variance of A, here's the variance of B, here is the covariance between A and B, and we combine them in this way. We weight the variance of A with the square of the market value weight that A is in our portfolio. So if it makes up that 45%, that's 0.45 squared times the variance plus 0.55 for the other asset squared times the variance of that asset. All right. So those are the individual components of A and B as they contribute to the riskiness of the portfolio itself. It's this piece of it where the magic happens. Because these two things, when you think about this, I square the weight, I've got a variance, which is by definition positive. So a positive times a positive is going to give me a positive here. I square that weight. It's positive. I have a variance, that's positive. So there again, that's another positive thing. So you're saying, well, wait a minute, Dr. Elliott, why is it that this portfolio variance is going to be lower? It's because of this third term. This third term, especially as it pertains to covariance between A and B. And we can rewrite that covariance. We can rewrite it like this. Instead of covariance, let's make it sigma A times sigma B. That's the standard deviation of A, the standard deviation of B, times the correlation. I use the rho. You could write it CORR like they do here. But rho of A and B, the correlation between A and B. Now, if the correlation between those two is 0, then this whole term cancels out. If the correlation between those two is negative, that's what I'm really after, right? Because if that correlation is negative, oops, where did that eraser go? If that correlation is negative, then this entire term, so I'm taking 2 times x, the weight of A, the weight of B, standard deviation of A times standard deviation of B, and then I'm multiplying it by this negative number, this whole term becomes negative. So that is reducing the portfolio variance. So negatively correlated assets are really valuable assets. That's what I really want to find, are assets that are negatively correlated with my portfolio, because they do the most to reduce the variance of my portfolio. All right. Questions, comments on that? Because again, this is one of the more important insights in this capital asset pricing model out of both of these chapters. Is that it's that correlation between those two things. Now, the problem with correlation and covariance is that we can only compare things on a pairwise basis. So if we have 3 things, it gets much more complicated. If we have 4 things, it becomes even more complicated. But we can still deal with that. We can just have additional terms in this equation. And then this just shows you basically the spreadsheet that I was showing you just a little while ago. And let's see, where else do I want to go? We've already talked about this. By the way, if you want to look at a spreadsheet that kind of simulates what I was just showing you in that spreadsheet where I changed correlation, just click on this slide, and that'll take you to a spreadsheet that you can do the same thing, kind of play around with that. The point of adding a third asset here is that that allows us to possibly move further in the northwest direction. In other words, higher returns, lower risk, or some combination thereof. When we do add another asset to our portfolio, here's what happens to the variance equation. The expected return equation stays quite simple. It just adds one additional term, and this is it. So we're assuming we've already got domestic stocks, domestic bonds, and here we're adding foreign stocks. All right, so we're just adding one additional term, and we're putting a weight on it. The weights still have to sum to 1, assuming that we don't add any leverage to this. When we look at variance, though, it gets a little messier, like I said. So we still have those first terms, so we just add that extra one right here for the foreign stock. But now, because we can only deal with each of these assets in a pairwise fashion, we have to compare the foreign portfolio to the stock portfolio, the foreign portfolio to the bond portfolio, and then the stock portfolio to the bond portfolio. So we actually have 3 additional terms. All right. And if we were to add 4, obviously that would add 1 additional term up here. And yet then we would still have to do, what are we going to call this one? We'll call this C. We would still have to compare, F with C and A with C, or S with C, B with C. So we're adding even more terms to our equation for variance of the portfolio. But ultimately, we're going to end up with some sort of line like this. Markowitz efficient frontier. Again, I kind of jumped the gun on that by showing you that on the spreadsheet that we're looking at. But the efficient frontier is that point above the minimum variance portfolio, and it's the point where we can't do any better than that set of portfolios. And that's pretty much the end of chapter 11. It's about 10 minutes till 8, so this is probably a good stopping point. Okay, so let's get started in on chapter 12. I apologize, it just didn't feel like that first half of the class went well. I haven't been feeling well, so I do apologize for that. actually not feeling so well that I went and got a COVID test, even though I've been vaccinated, and luckily it was negative. So it's just probably allergies or something. But so if I make another misstatement, you'll forgive me, I hope. All right. So chapter 12 is where we kind of wrap everything up into a nice bundle, and we end up with this thing called the capital asset pricing model. Some of the key things, though, that lead us there, and the thing they begin this chapter with, is how announcements affect price. And we know that announcements are new information, presumably, and they clearly have to affect price in some fashion or another. And it's usually through supply and demand, right? If we find out that the economy is doing better than we thought. So this last jobs report, that was nearly 1 million new jobs created, and they updated the prior jobs report to increase the number of jobs from the prior month. That led to a market rally, a bit of a market rally. But the important piece to recognize here is we want to know how much of this news was expected and how much of it was a surprise, how much was unexpected. And it's only that surprise or that unexpected news that is going to move prices. So if everybody expected the jobs report to be around 1 million, and it turned out to be, give or take a few tens of thousands, around 1 million, markets shouldn't move at all because that was already expected. Now, last month, when we had a jobs report come out, it was lower than expected. They were expecting about 1 million. I forget what it turned out to be, but it was substantially lower than that. Markets worried about that. That was a surprise. This month, not so much of a surprise. So always keep that in mind when you're looking at information and how it impacts the market. If a piece of information comes out and it's already what we expected, so let's say another example of this on just a firm basis, an individual firm. If analysts had expected earnings of 15 cents per share on a particular company, and lo and behold, the company reports its earnings on a particular day at 15 cents. Should prices move? No. Maybe just a tiny bit because it resolves any modest variance in expectations. So maybe one analyst said it was going to be 14, the other analyst said it was going to be 16. So we had some deviation there. Their average, it came out to be that average, but there's still some uncertainty in that. So there might be some slight price move as a result of resolving that uncertainty. But as far as surprise, no big surprise there. Now, if they'd come out and said we're losing 15 cents, boy, there would have been a big price decline. Or if they'd come out and said we made 30 cents per share, would have been a big price increase. But it's only that surprise that really matters here. It's the surprise that moves prices. That's also why when you go back and you study how prices moved in the past as a result of information, that's why it's just so darn difficult to figure out how much of that information was truly a surprise at that time. You almost have to have lived through that period to truly get what was a surprise and what wasn't. I mean, obviously, if it's something like earnings, we can actually track, and we've got a historical record of what analysts thought earnings were going to be. But if it's other news, how much was actually embedded in the marketplace at that time? It's hard to say, especially when you're looking back on it. So we break risk up into two components. We already really started looking at this in Chapter 11. And they kind of double down here in Chapter 12. And remember that chart that we looked at when we added additional securities to a portfolio, it brought our risk down. And eventually we leveled that at some horizontal level below which we couldn't move even by adding all the securities into our portfolio. And basically we call that the market risk. That is the systematic risk or the market risk. The risk that we could get rid of, that higher part on that curve, that is unsystematic risk, not surprisingly, or firm-specific risk or unique risk, or I could even add idiosyncratic as a list. There are many terms that describe that risk. Another term would be unpriced risk. And we could add priced risk to this. The reason that this risk is priced is that we get a return for taking this risk. We don't get a return for taking this risk, so it is not priced. Total risk is the sum of systematic and unsystematic for any given company. However, like I said, the only risk that we should take willingly is systematic risk, because this stuff, we get nothing for it. Oops. So the old idea of eggs not being in one basket is really what this is about. The non-diversifiable risk or the systematic risk or the market risk is what we want, or the priced risk. That's the risk we're looking to take. That's the only risk that we get a reward for taking. All right, so what is that systematic risk? How do we measure it? That systematic risk is measured by beta, the famous beta. The market beta is defined as 1. I put 3 lines there to indicate it's not just equal to, it's defined as 1. Everything else is a function of that. So betas, firms that have betas that are greater than 1 have more risk than the market. Now, you still have to hold that firm in a well-diversified portfolio. You can't hold it in isolation and expect to get that return and only take on that risk, because if you hold it in isolation, you're still exposed to that unpriced, idiosyncratic, unsystematic, firm-specific risk, right? So all of this is predicated on a well-diversified portfolio. When we calculate betas, and we're going to see exactly how to do that in just a minute, but when people out there and analysts and companies come up with a beta and report it, we get different numbers. So here we've got ExxonMobil by MarketWatch. They come up with a beta of 0.91. Yahoo posts a beta for the same, this is the same company, it's still ExxonMobil, of 0.68. We've got other examples here. Look at Tesla's beta. MarketWatch came up with 1.32. Yahoo has them at 0.55. How can that be possible? Well, it's the old span versus frequency story. How long a window did they use, and how frequent, that's the span part of it, and how frequent was the interval? Was it millisecond by millisecond, minute by minute, hour by hour, day by day, week by week, monthly, quarterly, yearly? And did I use five years? Did I use 1 year? Did I use 10 years, 15 years? There is no prescription within the CAPM theory for how to do this. Now, each of us might have our own method of how to do this. And personally, the way I look at it is, ideally, I would look at the company and I would say, how far back in history does the company still look like it is today? the riskiness of its assets, the business that it's in, how it conducts that business, where it is in terms of market, market standing, pecking order. Is it at the top? Is it have the largest market share? Is it a leader? 5 years ago, was it still in that position? Okay, it's more or less the same company as it was 5 years ago, but beyond 5 years, it's a different company. Okay, I'll go back 5 years to compute a beta. Or maybe it was a different company in terms of market share 3 years ago. Maybe it leapfrogged a couple of places and became the market leader only 3 years ago. So I'll probably only want to go back 3 years. Or maybe they acquired another company and it had a very different asset base, and that asset base had a different riskiness. Maybe it was uncorrelated with the old asset base. I probably wouldn't want to go back beyond when that merger occurred to calculate my betas, because beyond that, it was a different company. So I'm throwing in bad information with good. Now, many of these, data providers, they'll have some sort of fixed window that they look at all companies on. So it might be, we're going to use weekly data and we're going to use a 5-year window. So the span is 5, the frequency is weekly. Or maybe we even do it 5 years and do a monthly. And that's how you arrive at, 1.3 versus 0.55. Now, on that assignment, on the security analysis, instead of calculating your own beta, just to save you, it takes a fair amount of time to gather the data, figure it out the first time, and even come up with a beta that even makes reasonable sense. I'm going to have you just go to Bloomberg and pick Bloomberg's beta and use their market risk premium and the risk-free rate that they use for Sherwin-Williams. But what you would find if you were to go out and do it on your own is not only is this span versus frequency going to create problems, you might even use the same span. I've had companies where we picked a 5-year span and we did weekly, monthly, and quarterly. And we got a positive beta, one that was almost zero, and one that was negative. Same company, same span even, just different frequency. So these things are really a pain in the neck. And so when you look at a beta, even out of Bloomberg, always question, what are we getting here? What's this really mean? And does everybody else's beta sort of agree with this? And does it make sense to me? I mean, a company like Sherwin-Williams, is it about as risky as the market? I don't know. What do you guys think? That means if it is, it should have a beta close to 1. Is it half as risky? Then it should have a beta that's about 0.5. So you also kind of have to use the smell test. Is it make sense? Tesla with a beta of 0.55? I don't know. I'm not buying that. It just doesn't make a lot of sense to me. 1.32? Okay. A little easier to buy that. But, hey, you got a company like Yahoo reporting that. Portfolio betas, just like portfolio returns, is simply the weighted sum of the betas of the individual securities in that portfolio. Easy peasy. Nothing fancy there. So whatever the weight is, 45% on one times that beta, 55% on the other times that beta, add them together, that's the portfolio beta. And this is just an example of doing that with two stocks, Starbucks and Nike. Now we get into something that is more to the point. And this is again, another very important part of developing the capital asset pricing model. So we're going to consider a portfolio made up of asset A and the risk-free asset. Asset A has an expected return of 16% and a beta of 1.6. The risk-free rate is 4%. And of course, by definition, its beta is 0. There is no risk premium for taking a risk-free investment. So we simply have the 4%. Suppose that an investor places 25% in the risky asset and 75% in the riskless asset. And here we go. Let's see, we're 25 in the risky and 75 in the risk-free. And so we have an expected return of 7%. So that would be 0.25 times our 16 and 0.75 times the 4%. That gives us our portfolio return. The beta is simply 0.25 times the 1.6 beta. So the portfolio beta is 0.4. Now, if we were to place more of our money into the risky asset, obviously the return goes up, but so does the beta, or the systematic risk that we're exposed to. And likewise up here, if we actually borrow at the risk-free and invest that into the risky portfolio as well as our own money, our 100%, then we can increase the beta beyond what what portfolio A's beta is. Again, simply on a weighted sum. Now, let's take the excess return. Remember our friend excess return. That's the risk premium also. And let's scale that by the beta, which is the measure. So we've got the risk premium, that is what we get for taking on risk, divided by our measure of risk, that ratio. So if we do that for this particular security, what we get is a slope. You can think of this as a slope. So rise over run, rise being the market risk or the risk premium, and the run being the risk. And if we start over here with 0 beta, and we've got beta here on the x-axis, we have expected return on our portfolio on the y-axis. Start over here at 0 risk with our risk-free, 100% in the risk-free, 100% in the risky asset. Here's 50 in the risk-free, 50 in the risky asset. Here's 75 in the risk-free, 25 in the risky, and 25 and 75 in the risky over here. And then out here is where we have a leverage position. We have that long margin position. We've got 125% or 150% and so on. But everything falls on this line. That's our risk-return trade-off. And remember, it's really important that this is just the priced risk. This is the systematic risk. It's not the firm-specific risk, the idiosyncratic risk. It's none of that, because we're assuming that we've got this portfolio A that is already a well-diversified portfolio, right? So now let's go on and consider yet another portfolio and the risk-free rate, and let's call that portfolio B, and it has a return of 12% and a beta of 1.2. Which asset, and we can call this a portfolio as well, which asset or portfolio, A or B, has the higher benefit or the higher risk premium for each unit of risk? Well, A has a higher expected return, but B has a lower systematic risk. So it's not clear at the outset. Just comparing this number with this, it's not clear which is better. So why don't we do this? Why don't we actually plot B on that same framework that we just looked at with A? So here we have our risk-free again. Here we have plotted our portfolio or asset B, beta here on the X, expected return on the portfolio on the Y. And we've done this ratio. So risk premium over systematic risk. Here we get 6.67. What was it on the other one? Anybody remember? Wasn't it like 7.5%? And now, remember, this 6.67, we've always got that implicit 1 down here. I like to actually be explicit about it and put the 1 down there. So what that is saying is that portfolio B, combined with the risk-free asset, is yielding 6 2/3% return for each unit of beta risk. Whereas portfolio A is yielding 7.5% return for each unit of beta risk. Now we can answer that question. Clearly, nobody wants portfolio B, everybody wants portfolio A, and some combination of the risk-free rate. Right? So when we put these together, that's what it looks like. Now it's obvious. Even if we want our risk at beta equals 1.2, we still would not hold B. We would always be better off by holding A. In this case, we just have, we'd have some combination of the risk-free and the risky portfolio that would allow us to get this at this position right here. So holding risk constant, we can actually increase our return. Okay, everybody good on that? So portfolio B just goes away, right? Or does it? Not necessarily. Right? I mean, we can look at this from a couple of different angles. One is a more theoretical angle, and we could say that the only priced assets exist, only assets that help make up that portfolio exist. From a more realistic standpoint, a real-world standpoint, we look at it, well, if the company is making some money, it probably still exists. Somebody's willing to buy those shares. Right? So here's what actually happens. We're assuming that both of these assets, both of these portfolios are going to exist in some form or another. Now, that risk-return trade-off might be a little different than we had initially set it up because A is completely dominates. And when you're talking to a statistician, you could say A first order dominates B. In other words, along all possible combinations of risk and return, I would always prefer to have A over B. There's no situation where B dominates A. Now, when that's the case, investors will be attracted to A, and they'll buy shares of A. They'll want to get away from B, so they're going to be selling shares of B. This buying and selling means that the price of A shares or the A portfolio goes up, and the price of B shares or the B portfolio goes down. Now, why does this make sense in a return world? Let me give you kind of a little shorthand, easy way to think about this. Let's think about just a one-period world. We start at time 0, and our investment world ends at time 1, period. That's it, 1 period. If the payoff at the end of time, at the end of our 1 period world, is $1, and let's say that shares of A are selling for 80 cents, and shares of B are selling for 90 cents. Well, as I as I demand more A, I've got a limited number, but there's more demand than there used to be. That's going to drive the price of A up. And as I sell B, that's going to drive the price of B down. Now, as the price of A's shares go up, it becomes pretty obvious that the return, which is, what I paid, 80, let's say it's 85 cents now, versus what I get, $1 over 85 cents, I've got a 15-cent gain on an 85-cent investment, whatever the percentage that turns out to be. So let's say it keeps getting bid up even further. Then it's 87 cents on an 87-cent investment. So that becomes a 13% or a 13-cent gain on an 87-cent investment. You get the idea. The return drops as the price goes up because if we think about this ending price as always $1. So use that little trick to think these things through. This is how bidding up the price of something actually lowers that thing's return. So you can think about it in that context, and that'll keep you on solid ground, at least when we're talking about theory, CAPM theory, and the return on each security. So bidding up the price of A reduces its return, and prices of B are being bid down. So instead of 90 cents, they're down at 89 cents. So there's more return for B. Eventually, we're going to get to a point where these two ratios, remember we had 7.5% and 6.67% over here. This bidding war, though, between A and B, selling B and buying A, is going to drive these two ratios so that this equality ends up holding. Is it going to be 7.25 on both, or is it going to be, 7.1 on both? I don't know. That doesn't really matter. But that effect is going to drive this ratio so that the return per unit of risk is going to be identical between these two firms. Now, the riskiness of each firm is still 1.2 and 1.6 on B and A, respectively. But the reward, the risk premium that I get, is what is going to be shifting around. The reward to risk ratio must be the same for all assets in a competitive financial market. If it isn't, I immediately get in there and arbitrage it away. For instance, here I've got asset A, I've got asset B. Those both fall on this line. Those are both efficient outcomes. Their their reward to risk ratio are identical. The ratio is identical. The amount of risk in each one is different. But what I get per unit of risk for each one is the same. Now, C, on the other hand, C is problematic because I'm getting more return than it looks like the market says I should be getting. So when everybody sees C, what do you all do? We all run out and buy more of C. Bids up the price, lowers its return, drives C back down to this line. What happens to D? D is down below this line. It's getting too low a return. We're selling off D, and that effect is driving D back up to that line. When everything is in equilibrium, both C and D, as well as A and B, are going to be on that same line, and they are going to have the same amount of risk, or they're going to have the same amount of return for a unit of risk. That's really, again, one of the more important insights in the capital asset pricing model. Security market line, that's this thing right here. and that's the slope of it. That's the rise over the run. Let me fill in. I thought this was fixed, but obviously it is not. Let me fill in the missing functions there. So this then is the capital asset pricing model. The expected return on security I is a function of the risk-free rate, the expected return on the market, and the beta on security I. And basically that comes out of this relation here. Let's see, let me fill this in. Yeah. There's an implicit 1 over here. And then we do a little bit of rearranging and we end up right here. And the rearranging you can work through if you feel like it. It's relatively simple. Just algebra. But that's how we get this result. And when we plot the market, which has by definition a beta of 1, this is where the market is. That's the what we call the market portfolio. Now, all of the other assets or combinations of those fall somewhere along this line. And if anything were to get off of the line, that bidding up will drive it right back down, or if it gets below the line, the selling off will drive it right back up. All right, now where do betas come from? Let's see. All right, there we go. Well, if I were to calculate the correlation between the securities returns and the returns on the market over some specific period of time, same period of time for each, I could calculate that correlation. I could also calculate the standard deviation on the securities returns and the standard deviation on the market returns. And if I multiply that ratio by the correlation, that is going to give me the beta. That's one way of getting it. So if you were in Excel and you had the returns for the market, you had the returns for the security side by side in each in a column by itself, and you'd go equals CORR, open parens, and highlight those two columns, close parens. That would calculate your correlation. You could do the standard deviation of each individual column and then do the math. You could get a beta out of that. Another way to get a beta, though, and this is just an example of doing that. Another way, though, to get a beta is to run a regression. And if you all remember from your econometrics class or your statistics class, business stat, that a regression is simply, at least in the case of an OLS, an ordinary least squares regression, what I'm doing is I'm looking at the plot of points. So at a particular time, the market was at negative 12-ish%, and the stock return was at like negative 9-ish% at that whatever period of time it is, same time for each, and I plot that point. And then I find another time, a quarter later or a year later, and the market was at about 9%, and the security was at about 10%, and I plot that point. And another period of time, the market was at about 16.5. The security actually in that case was about a negative 5%. And then I've got two more points that I plot. Now, what I try to do when I run a regression is I'm looking for a single straight line that when I run it through this cloud of points, and then I measure the distance from that line to each point, and I square that distance, and then I sum up all of those squared distances from the line. I'm picking the line that gives me the smallest sum, right? So this particular line down here, this line, if I take the difference from that point to the line, this point down to the line, this point up to the line, this point up, and then this point down, I square each of those distances and I sum it up. That is the line that minimizes the sum of the squared differences from the line. If I picked this line, it would not do that. That would not be the sum of the squared distances from the line would be greater. If I picked this line, that too would be greater. It's this one unique line right there. And that's what OLS gives us. I'm not going to go into the details. You learned about that in your business stats or your econometrics class. But that line is the OLS least squares regression line. And the slope of that line, the rise over the run, is beta. So basically, I'm plotting the market against the stock returns. I'm running a regression over that over the series, and I'm getting that line. The rise over run is beta. Pretty simple when you look at it in that context. There's a lot of math and a lot more in terms of assumptions and building that entire theory up. Believe me, you could spend an entire semester as a doctoral student studying that stuff, because I did. There's a lot of math in there. There's calculus just everywhere. But the essence of it is right here. So believe me, there's more there than it looks when you read it in a more simplified form. Another thing that I like to point out when we're actually estimating these betas, you remember back to that earlier slide where we saw Tesla, with a difference of like 3/4 of a beta between one person's estimate and another person's estimate. When you do run this regression, let's say you're using Excel, and one of the functions in Excel allows you to run OLS regressions. Okay, so we've got our returns for the market. We've got our returns for the stock. Remember, it has to be returns, not prices. You've got to get the return. Once you do that and you use the regression function in Excel, you get this nice little table. And again, from statistics class, hopefully some of these things look familiar. We want to see, we've got a significant regression. We want to see whether that's significant or not. Another way to look at how significant and useful the regression is to look at the R squared. Okay? Usually that's written this way. R squared is, in essence, in words, what R squared is it tells us how much of the Y variable, that is your left-hand side variable, how much of your left-hand side variable is described, how much of the variation in your left-hand side variable is described by the variation in your right-hand side variable, the X variable. In this case, the market is the X variable. So how much of the variation in the stock is described by the variation in the market? That's what R squared is really getting at. And then there's this other R squared down here. And in fact, that's the only one that should matter to you. You should ignore that first value because that's not adjusted. And I want a well-adjusted R squared. I don't want a unadjusted R squared. Now, the reality of it here is that by virtue of this process we call OLS regression, when I add a variable in there, by definition, I'm going to get some relation between that. And if I add another variable, even if it has zero true correlation with the left-hand side variable, it's going to increase my R squared. And if I add a third variable on the right-hand side, it's going to increase my R squared again, even though there's no predictability whatsoever. So we make this little adjustment to kind of reflect the reality of how much truly of the variation in X is describing the variation in Y. And in this case, this 0.35 is telling us that about a third, a little bit more than a third of the variation in Y is described by the variation in X. So you might think, well, that's not bad. But the other way, let's look at it the other way. That means that 2/3 of the variation in Y is not being described by the variation in the market. And I got to wonder why. Yeah. Theory says it's just the market. Well, in reality, in the real world, it isn't, folks. And in fact, getting an adjusted R squared on the order of like 0.05 or 0.09 or 0.12, very commonplace. So in other words, only 5% of the variation in Y is being described by the variation in the market, or 12% or 9%. Really, really, really low number. You know, that leads you to believe, hey, 95% is not related to the market? What the heck is up with that? So I always encourage students to look at, you know, this was obviously if you were going to calculate your own betas. We're not going to do it. Nobody reports R squared in the industry. I find it extremely valuable because when I've run this, and I've run thousands of these regressions in doing my research, you find that R squareds are really, really, really low. And that's problematic because we're kind of betting that this R squared is right. And what this regression is saying, well, yeah, 5% of it's right, but the other 95% we really don't know, at least according to this model. So be very cognizant of R squareds when you're out there in the real world, folks. The other thing to look at here, of course, is this highlighted cell. That is our beta, right? Our first coefficient. We've got an intercept. That's what it says it is. And then we've got our first coefficient, which is the market returns, and that is the beta. The other thing to look at when we look at a beta is to look at its t-stat and to look at its p-value. And again, these things are highly correlated with R squared. So in this particular case, this beta of 0.9 and this p-value of 0.17. Anybody remember what's a good p-value? What would you like to see as a p-value? Is 0.17 good? What would be better? Think back to stat. I know at the time you're thinking, this is meaningless. Oh no, it's quite meaningful.
Is it like 0.05?
Yeah, exactly. Thank you, Benjamin. So 0.05 would be a good p-value. 0.17, not really impressed. And in fact, what I would say as a econometrician is that the slope coefficient of 0.9, which is almost the market, right? It's almost 1. But as an econometrician looking at this p-value, I would have to say that it is not statistically different from 0 at the 5% level. So if I use 5% level as the threshold, since this is at the 17% level, it is not statistically different from 0. In other words, this beta is really 0. That's how lousy this beta is. It's a pretty bad estimate of beta. I'd really like that to be at least 0.1, if not better yet, as Benjamin said, 0.05 or 0.01, even better yet. When I'm publishing research, if I don't have a 0.05 or a 0.01, which we also signify with 2 stars or 3 stars, respectively, I may as well hang up the study. It's over. Nobody's going to publish that because there's no statistical difference. It's not statistically different from 0. Yet, people run these regressions all day and ignore these important little things over here. I'll bet you if we looked at those regressions from MarketWatch and Yahoo, we would find a bunch of p-values well above 0.1, which is the worst case scenario, right? That's the 10% level. And that's a two-tailed test. And we need a two-tailed test here because it could either be too high or too low. So watch these things. These things, we're putting a lot of money behind this beta. And if the beta is garbage in, we're going to get garbage out too. So that's why I spend a little bit of time thinking about this from a statistical or an econometrician's point of view. It's something that I think is missing. Now, one other thing. Why are these numbers, in this case, why are these numbers so bad? What else tells you about that? Somewhere there, right? Yeah, we only have 4 observations. And so, yeah, it's not surprising that these numbers are pretty lousy. But I'm here to tell you that even when you have 60 observations, these numbers can be very, very bad after having run thousands of regressions like this. I guarantee you. Already pretty much talked about this slide. Be careful of betas. Extending CAPM. The expected return, does the expected return depend only on beta or do other factors come into play? Well, since the seminal work that was done on the capital asset pricing model, there have been dozens of models proposed, most of which include beta, but add additional factors. And part of that relates right back to here and this R squared, because these R squareds were just so terribly bad. So people started saying, well, wait a minute. There's this small firm effect, and there's this market to book effect, and they seem to have quite a bit of difference in returns. Why don't we add 2 more factors? And that's what we call the Fama-French, the Fama-French 3-factor model. So basically, they have brought into play, in addition to beta, what Fama and French called the small minus the big and the high minus the low. And that refers to market cap in the small SMB, and that refers to book to market in the HML. They looked at it as book over market. Many people look at it as market over book, just opposite inferences. So a high book to market is actually a value stock. A low book to market is a growth stock, AKA. Very similar. Oftentimes we're looking at PE and things like that, but generally speaking, you get the same sort of inference when you look at market to book. There are also other models that have been proposed. Carhartt, the Carhartt 4-factor model, is another model that's been proposed. That adds yet an additional factor, momentum. Stocks that were rising continue to rise over a certain span of time. Stocks that were going down continue to go down over a certain span of time. That's the momentum. That's that idea behind momentum. Kiwei Hu has added a 5th factor. In fact, I don't believe his other factors are identical to Carhartt and Fama-French, if I remember correctly. I've got a link to his paper. This is a relatively recent paper. The 5-factor model his Q5, aka Q5, performs extraordinarily well. He presented here at Case Western a couple of years ago. He's a brilliant finance researcher down at Ohio State. So, don't just depend upon beta. There's much better work out there. And it's not that much more difficult, especially the Fama-French three-factor. That's been around for decades already. And it's relatively easy to implement. So don't put all of your eggs in that basket either. Don't put them all in the single beta basket. It's not a good basket. Let's see, what else did I want? I skipped over these things, and this is also important. Critical assumptions that underlie the development of the capital asset pricing model. We've already talked about rational, risk-averse investors in Chapter 8 when we were discussing behavioral finance. Not all investors are rational. Their errors don't cancel each other out necessarily. We're kind of depending upon there being arbitrage to get rid of those. We still don't know for sure. Some other of the important aspects here. All investors are price takers. Nobody can influence prices. That's an assumption underlying this model. If you can influence prices, and I think you could argue that there are some investors who could influence prices, the model starts to fall apart. Trade without transaction costs or taxation. It's not factored into the model. Homogeneous expectations. In other words, we all have the same set of information as everyone else, and it encompasses all information available in the world, and we have similar expectations about how that information impacts the value of each of the securities. That's a pretty hefty assumption, but it was necessary to make this model tractable. So here's the all information pieces of it. Many of these assumptions have been relaxed to some degree and incorporated in different ways. For instance, this idea that everybody knows everything about every stock. Bob Merton, again, another brilliant finance researcher, posited a model where not everybody knows everything about every stock. And he said that in the ideal, we approach CAPM, we approach beta. But if we have a subset of investors that are aware of a stock, the other investors can't really invest in that stock because they don't know whether it's a good stock to invest in. They may not even know it exists. So those companies will have a higher discount rate. They'll have a higher required rate of return. As more investors become aware of the company, their rate of return will decline to the point where eventually it converges with the required rate of return for that particular firm as described by CAPM. So some of these assumptions aren't a big deal, but you should be aware that there are assumptions underlying these models. And to the extent that these assumptions are violated in the real world, it could have an influence on the applicability of the model to real world assets. But like I said, this model's been around for over half a century. And as a result, many of these assumptions have been relaxed considerably. Let's see, that's it out of chapter 12. Wow, we're 20 minutes early. Man. Maybe we will get to stock options. I'll still hold off on that decision until Thursday. Questions at all about either chapter 11 or 12? Going to have a little extra time to maybe work on your Sherwin-Williams security analysis. Any questions about that might have come up? Nothing?
When is the second part of the BMC due?
I didn't set a deadline for that. I don't want you to not study for the final or not focus on the security analysis. I'm going to have to look at when grades are due. And what I'll do is I'll put it due the day before grades are due. So I'll have grades ready. All I have to do is plop that piece into the spreadsheet and off I go. And I want to say that grades are more than likely going to be due the Monday following the final exam, which is next Thursday, a week from this coming Thursday, rather. So that would be a week from next Monday. So if I'm probably going to set the deadline for what is that? The 22nd. That's a Sunday, I believe. And then that way you've got a couple of days after the final. You got no studying otherwise to do just to wrap that up. Any other questions?
Yeah, real quick. I saw in the assignments tab that there is an undated assignment. It's like chapters 15 and 16 practice problem or something.
Oh, yeah. Sorry, that's a carryover. You can look at that if you want. It's 16 actually gets into pricing of options. It's a good chapter if you're interested in carrying on, but we definitely won't get to that. Last semester we had an extra week in the semester, and so instead of dropping a class or two, I threw in chapter 16, and I apologize. I moved everything from that semester into the summer, and so I didn't pull that one out yet. So that's superfluous.
Gotcha. I figured I didn't have to worry about it.
Yeah.
I just asked. So.
Sure. No, always good. Thanks, Alan. Any other questions? All right. I will see you all on Thursday. I've got one appointment for tomorrow. I've got other times available if any of your teams have questions as you're working through the pro forma. Make sure that you've checked the video first, but if you're still in doubt or maybe I didn't answer the question in the video, also look at the FAQs in the assignment and the additional notes section. But if those are either unclear or didn't even answer your question, feel free to reach out either via email, and if it's a short question, or just email me and we can set up a Zoom session. So good luck, happy studying, and I'll see you on Thursday.